This is episode 100. That means 2 years of consistently posting at least one time a week here on the podcast. And keep in mind, that's not including the lives that we do on Fridays. So 100 episodes. So in today's episode, what we're going to do is we're going to dive into lessons learned over the course of 2 years when talking about mortgage, when talking about real estate, maybe some life lessons in there as well. So Josh, you're coming off being sick for a little bit here. So we're going to see how that plays into an extended conversation, but welcome back.
So yeah, if Josh fades away during the second half of the conversation, you'll know the fatigue is setting in and he's just soft and weak.
But something to note on that, 100 episodes, that means we showed up every single week for 100 weeks, if you will. And sometimes we did 2 in 1 week, but whether we were sick, whether something was going on in life, we consistently showed up here every single week to provide some value. So, I'll ask really early on in the episode, if you support the work we do here, if you find any value in it, if you're listening on the podcast, you can share it with a friend, you can rate the show. And if you're on YouTube, you can, again, hit the thumbs up, subscribe to the channel if you're not done so already. So with that, Josh, let's start with just really the first thing, life lesson, not even life lesson, a lesson that we've learned over 2 years of consistently showing up week after week.
Let's start with the first one. And I think it's a very important one because people misunderstand or I think take the wrong conclusion out of this. And that is that the market is unpredictable. No matter how smart you are, no matter how great of data you have, you do not know what tomorrow brings. None of us do. So a lot of the comments that we'll see online, people say, you don't know what's happening tomorrow. You're stupid. Well, okay. We might be. We may be. That could be true. But you still have to look at the data and project what is the most likely outcome. We talk here. I've talked multiple times. One of my favorite books is Thinking in Bets by Annie Duke. She says, if someone tells you something with absolute certainty, the best way to knock them off their game is to say, want to bet? Want to bet your life? And very few people are so certain of anything that they would be willing to bet their life or their life savings or their family or any of that. And it makes you realize that there is uncertainty in everything. So we do not show up here each week to tell you, here's what's happening now, here's what comes next, act this way, therefore. It is, here's what we're seeing. Here's are the things that we keep an eye on, and here's what it looks like comes next, and how could the script deviate from the way it looks like it's going to play out. But again, the big key takeaway, I knew going into 100 episodes, that the market was unpredictable. Mm-hmm. It's taught me, the last 2 years have taught me that it's far more unpredictable than I gave it credit for.
No, I mean, and I think when we talk about that, one of the things that we've gotten wrong on the show is interest rates. Now, a lot of professionals out there in the industry have gotten that wrong as well. But again, it's unpredictable because we're basing it off certain information, which, the people making decisions in the areas that affect rates maybe not using the same information that we're using because we're using current information. Sometimes they're using lagging information in order to make these decisions. So, when saying the market's unpredictable, again, we're not telling you anything you don't know, but understand we're doing the best with what we have at that given time. And as things change, our opinions may change, which really takes Josh into the second thing here. And that's the data doesn't lie, right? So for the better part of 3 years, we've been on here on different platforms talking about the housing market remaining stable, prices going up, no crashes happening. And how are we coming to that conclusion? I mentioned we were wrong about rates, but we pretty much nailed the idea that there was going to be no crash in house prices and that the market was going to continue to have the steam behind it and push forward even in a risky environment, even in a tumultuous economy and things going on. And that's because you're looking at the underlining factors there, and it goes back to supply and demand, right? Always Econ 101. If you have more supply of something than people want of said good, if you will, then you're going to have prices come down. They're going to have to correct. But on, adversely talking, if you don't have enough supply to keep up with the number of people that want whatever product it is, housing, it could be anything. Used cars. I mean, take that back into the pandemic. What happened to used car prices? They went crazy because there wasn't enough out there in the market. Well, that's corrected. You've seen those prices come down. On the housing side, housing hasn't corrected in a meaningful way with the number of supply. We're still sitting really near historically low levels when you look at the big picture, and therefore prices have remained stable. So when I say that, Josh, what are your thoughts?
Well, it goes back to that idea of relative supply and demand. There are enough houses out there for anyone that wants to buy a home, but then you have to come into account and take into account the idea of someone has to be able to afford that. Someone has to be willing to do that. Someone has to want that. So there's no doubt that we have less demand. Able demand. We talk about the difference between willing and able. Always people willing to buy a home. The homeless person on the street is absolutely willing to buy a home. They're not able to. So when we look at that, we have less able demand than at any point due to the affordability issues with high prices, high interest rates. But at the same time, because of that lock-in effect of people not wanting to sell their homes and give up their low payment for a much higher payment for a slightly superior home, we have this supply demand balance that is keeping prices just slightly going up. What did we going to end up last year, Jeb? 5%, which historically is right about average,
Yep.
which we would not have expected coming off 2 years of really outsized home price appreciation. You would expect some moderation, whether that's 3-4 years of zero, whether you would expect a 1 or 2 down years, which we had, 6 down months. Mm-hmm. So really, the key thing is look at the numbers and leading numbers of, inventory coming on the market. We show the charts every week on the live show, Jeb. It's pretty basic data. It's about 6 or 7 charts that tell us the story, high frequency data that if and when this turns, we will see it coming. But for now, we have a story of not enough homes for a generation of home buyers, millennials and Gen Z coming behind them that are coming of home buying age and want to own a home, and there's not a lot of supply for them. So those that can afford are still stepping in and pushing prices marginally higher from where they are.
No, and again, it's the market that we're in, right? Things change over time. And I think a lot of people, people aren't buying homes continuously. Therefore, they're not paying attention to the housing market continuously. A lot of people pay attention when they're thinking of purchasing, they've recently purchased, they feel like, they're going to sell and repurchase again. So that's when people are in the market. So therefore, they're looking at the data maybe every couple of years. I mean, I think the average tenure on a home right now is like 11 years or something. So most people aren't looking at the data like we're looking. So when you're only looking at the data once a year, once every 2 or 3, or once every 10 years, it's really hard to make decisions based off that. Whereas we're looking at the data every week. Now, some might say that's too much, but what happens is when you look at the data every week, you notice nuances in the data. You notice when things change, trends change. Well, we're coming from you, reading this data every week, bringing it to you every week on the live show so that, you can have some context, some idea of, okay, this isn't out of the norm. This is completely normal based off where we were, say, the same week last year or the same week, a month ago, whatever the number is. So just, again, comes with context, comes with understanding the data. We do the best we can with what we have at that time. But we're always fighting the last war, Josh, which is really point number 4, right? I mean, if we've learned anything here, you're always fighting maybe it's the previous Fed, what they did, or maybe it's the current Fed, what they did during a specific time in the market, the pandemic, if you will. We're still fighting the, quote unquote war from 2 to 3 years ago. But thoughts?
Well, not only that, history doesn't always repeat itself, but it certainly the scars, but the scars also continue on. So the current Fed is looking back to the late 70s, early 80s when the Fed had hiked and then eased and inflation came back in. Mm-hmm. So we're sitting there from that perspective in terms of what the Fed is doing. They're going to, and already have, pushed much farther than what most people thought they could, would, or should do. And when we hear several Fed speakers out in the last week where the Fed futures market is expecting 6 cuts in the next year, the Fed themselves is projecting 3, and several speakers out in the last week saying, I don't see a cut coming in the first half of the year, and we need some really strong evidence that we're progressing towards 2% inflation before we cut there. And you and I have sort of reverse engineer the numbers. By the end of the first quarter, we should absolutely be very close to 2% on the core, whether that's 2.2, 2.4. We're going to be very close to it. And there are signs, cracks throughout the economy. Not that there's going to be a big recession, not that the market is going to just tank, but that it's not going to be this strong, robust economy that can withstand the negative pressure of really high interest rates like we've had over the last couple of years. So there's that piece of it. But Jeb, from my perspective, when I think about fighting the last war, the biggest and most obvious one is all of the buyers that are coming of prime home buying age that are 28, 34, 37, they were 15, 20 years old during the last downturn. Yep. And they think that a catastrophic market crash is the end of a real estate cycle. So we're at the end of a real estate cycle, or we've had a big run up. So there has to be a cataclysmic crash. And they don't look at all of the things that went into that. And there's two really big elements that are sort of obvious and different from then until now. One of them is the garbage loans that we had at that point in time. People did not have to qualify. People did not have to have good credit. People did not have to have a down payment. It was literally almost incomprehensibly easy for someone to become a homeowner, whether they could afford it or not. So we know, everyone's seen The Big Short. Everyone knows how we had toxic loan products. But on top of that, we had builders that built heavily into a demographic downturn. So we had Gen X was a small baby bust after the baby boomers, and they were at prime home buying age at that point in time. And we're building more homes than they need at a time when their ability to finance them was pulled out from under them because of the garbage and bad loans. So everyone looks back to that and goes, well, that was the last time we had a cycle end, so it has to happen that way again. And there's just really, there's a million different pieces of data that line up that say it's not going to look anything like that. So unfortunately, we have had for the better part of 10 years, you've told the stories, Jeb, of clients that sold in 2016, 2017, because the market was going to crash. We had people who have put off buying, who have not wanted to buy because the market is going to crash. And now many of them are just flat out priced out. They are no longer able demand. They're willing demand. They'd like to buy a house, but they're not able to. So when you're looking at things and projecting through things, you cannot look back and say, the last time the market turned, this is what happened. So the next time it's going to happen. And that includes people who are unrealistically, irrationally optimistic of going, I'm going to wait for the foreclosures to come, and then I'm going to get one of these houses for 50% of what they cost today. It's not going to happen. You are not going to have that opportunity. So it's not a risk that you need to avoid. It's not an opportunity that you should be waiting for.
No, I mean, we often talk about people buying emotionally and justifying logically, but the same can be said true. People sometimes don't buy because of emotions, right? They get caught up in these ideas that they've created in their own minds, or maybe parents, people that have been through, quote unquote turmoil, have put these thoughts in their heads, and therefore they're kind of hesitant to make that decision because it is a big decision, and people think it has to be perfect every single time to make that decision happen, or in order to move forward on that decision. So, and a lot of it, Josh, has to do with our own biases, which I think is going to bring us into something that, is a lesson learned, is that we all have biases, right? You and I firmly believe that home ownership is important in people's life, that everybody should try to do it at some point in their life, just because of what it leads to at retirement. But with that, we often come across as being permables when it comes to housing, that, we rose-colored sunglasses, that sort of thing. But adversely, when you look at the media headlines and a lot of what, gets clicks out there on the internet, is it's this doom and gloom mentality, right? That things have to crash, that things are going to crash because of all of the things that we've previously talked about here in the video. But then when you click on the article and you get into the context, a lot of times, I would say high probability, 8 out of 10, the article isn't really even about a crash. It's something to draw your attention to get you to click on it. And then they may or may not even explain the direction that they're going. And so the biases type mentality out here is that, whatever you believe to be true is what you're going to lean towards when you start to look at data and you look at the market. If you're one of those people, doom and gloom, you believe the housing market's going to crash, you're probably going to get a lot of that in your inbox, in your feeds, because guess what? That's what the algorithm does. Just like if you hit the like and subscribe here, the algorithm will feed us more people like you. So do that. But if you're watching a lot of doom and gloom out there on the internet, guess what? You're going to get more doom and gloom. And that's going to continue to feed that cycle in your head that's what all the news is portraying. Whereas if you're a more positive person, you start looking at channels like this, trying to educate yourself, you're going to get more positive information. Doesn't mean you're not going to see the other information, but just understand that there's always going to be two sides. And it doesn't mean that the two sides are that far apart, but the headlines can be, dramatically different. So Josh, biases, how are they playing into lessons that you've learned in this conversation?
Well, I like to look at it in terms of something that is easy to accept that you're biased. If we talk about people are racially biased, people are biased against a religion or a certain group of people immediately dig in their heels and go, no. But probably the best example that was ever given to me, you and I both in the past had our CrossFit Level 1 certification, and they make you take a test. So we had to go back, take the test. And the last sort of seminar that was given was a guy, Chuck Carswell, and he was talking about bias in programming. So the way he was explaining it is if you're a big guy who can deadlift 500 pounds and you run the gym, you're going to be programming heavy lifting all the time because that's what you enjoy. That's what you're good at. If you're a 100-pound girl who could run for 100 miles, there's going to be a lot of long 40-minute workouts with lots of running in it. And everyone can go, well, yeah, that's kind of true. That sets up well for me. And that's the direction that I'm drawn to. Well, that is true in every area of life. So it is important to step back and say, why do I believe that? So if you're saying, hey, I think home prices are going to drop, is it because you can't afford now and you're telling yourself they have to drop so that I can get in? Are you looking at the data and thinking that it's absolutely tells you here's 10 data points that all line up that tell me that it's going to drop? And on the flip side, if you say, hey, I am absolutely ready to buy, is it because you have, you're dating someone and you feel like they'll marry you if you own a home? There's any number of reasons why people can be biased towards or against something, but you really have to step back from that ledge and just say, what's the logic here? And not one piece of data, not trying to find the one or two or three pieces of confirmation bias data that will say, yeah, here is where the market is going. It's step back and compare 20 numbers. And largely, Jeb, that's what we try and do every week is pull out the data and the pieces of information that have been predictive over time that will give us the best idea of what is going to come next, despite the fact that in number one, we told you that is unpredictable.
Yeah, I mean, it's separating the noise, right? And part of that, like you said, is the unpredictability. But we've talked about, again, data not lying. One of the things out there in the market at the moment is this lagging data effect, right? That the Fed, I think, is aware of now. It's and part of the reason that the market didn't overreact to CPI numbers last week, coming in maybe a little bit hotter than expectations, is that we know shelter data is a lagging indicator in the market, about a 12-month lag on it. And we know those numbers, rent numbers, the prints are going to continue to come down, which because it makes up such a large percentage of CPI, how it's reported, we know that as that number comes down, inflation is going to fall in a more significant way, which is going to get us closer back to that target. And so it's really easy to look at the number per se and say, hey, inflation's not coming down. See, it just came in hotter than expected. Okay. Context, right? We have our biases, right? To some extent, we are looking at the data, but it looks as if, hey, they're just saying X because that's what they want to happen. Well, on the flip side, you got people saying, well, hey, that's not true because this number's coming in here because that's what they want to see in the market. So what you need to do is just step back, breathe, separate, your thoughts and what you want to believe to be true from fact and make decisions based on that. Something we often say, Josh, is, or we didn't say it, we repeat it, is that the market can remain irrational longer than you can stay solvent. And the idea that, hey, there's all of this volatility in the market and it can be like that longer than we think, right? Just like we thought rates would come down sooner. Rates stayed higher longer than we thought. In fact, they're still higher than we thought they should be at this point in time, just based off the data out there in the market. But it doesn't mean that everything else we've said is not true. It just means, hey, listen, it takes some time for this data to catch up in some cases, to report correctly so that, we can actually see what's going on now versus looking at data that's, 6, 12 months old.
Jeb, you gave us the best example there that I can think of here recently of separating signal from noise. Last week, that CPI data came in hot, but you and I 2 weeks before that, we're talking on the live show, hey, it's going to be a higher number. And you're going to see headlines that are going to tell you, oh, it looks like inflation's getting a toehold. And you look at it, you're like, you almost can't believe it when you're reading the stories that are saying, ooh, it looks like inflation's going to be tougher to overcome than the Fed had initially hoped. And you're like, why? Because of 1 month of data, you can look back over the last 5 years, the last 50 years, you get these outlier months of data. And the outlier could have been last year in the data that's falling off that then makes this year higher, because it wasn't a super high month over month figure. But we had a really low figure fall off from the month before. But you have to look at it. That's why we look at 12-month averages, 6-month averages, 3-month average if you're going to be really aggressive in trying to see those inflection points. So if you look at last month, you go, oh God, inflation's going to stay high, rates are going to stay high. What does this mean for the housing market? When in reality, we know that we have to, due to base year effects, the next 2 to 3 months, we're going to see that number coming down. Really, what we need to be looking out at is about 4 months ahead of time. That's where the next signal is going to come. Everything that we're looking at right now is much less signal and more noise. We need to look at the longer term average and where it is going. So just be very careful and judicious with your news sources. I hate to sound like a broken record beating up on the news media, but if you look, a lot of these people that are writing articles are in their early 20s. They're just fresh out of business school, journalism school. They haven't been through cycles, and they know that they're going to be judged on how many views their article gets, not on how accurate the information was.
That's good info. So we've broken down some good stuff here, but I honestly think this one is probably the most important. And that's that mindset's everything. And that doesn't really have to do with housing in general, just in life. Mindset is everything. But it goes back to everything that we've talked about today. Biases, context in what it is you're reading or being told, understanding the underlying principles of that information. But in buying homes, there's this belief that, the American dream is dead. I'll never be able to do it. Housing is just, out of control. I'm stuck being a renter for life, whatever the mindset is. In fact, we've done an entire episode on mindset, but I will tell you, when you read the comments of people that post on videos and, respond on podcasts, it's always this negative mentality that I can never do it. And again, whether you believe you can or you believe you can't, you're right. And so let's talk about mindset, Josh, when it comes to buying a house, where you need to be mentally in order to set yourself up for success.
There's just a number of things that you need to overcome. That whole perfectionism mindset that there's going to be a perfect time, whether it be, hey, after I get this raise, after I get married, after we have our first kid. There's a right time. There's a good time. There's definitely wrong times to do it, but there's rarely, if ever, a perfect time for you to enter the market. So if you're sitting around waiting until you feel like all of the stars are aligned and you're getting this, signal from God that it is now the time to buy a house, it's not going to happen. And unfortunately, we see those perfectionist types that are waiting for all the signs and for everything to align, push it off, push it off, push it off, and they never get time on their side, which time in the market, as Jeb has said many times, is as important, if not more important than timing the market. You start paying down principal, you start building up equity as the home price appreciates gradually and slowly year over year. So that piece is really important. Jeb, one of the big ones that we hear all of the time is that it was easier for everyone that came before us. I'll use the example again. When I bought my house in 2003 at $580,000, my aunt told me, that's crazy. No one should ever pay that. You're going to lose your ass on that. And why? Why did she think that? Because she had bought a very similar house 25 years before for $32,000 or $35,000. And you go, yeah, it would have been great at 35,000, but they also, her and her husband combined made like $1,400 a month at that time. So that was what they could afford. So you have to take context. And even at that, I'm sure her parents said, well, we bought our first house for $1,800. What are you doing buying a $32,000 house? Like, it's very difficult for people to accept that things change over time. And I say that realizing that housing prices to income are higher than they have been historically, but that's a trend that we've been seeing go on for 50 years. So it is a little bit more difficult, but it's not impossible. It's not, this insurmountable task. And it wasn't as though it was just easy for anyone 20 years ago, 40 years ago, 50 years ago to walk in and have a house handed to them. Jeb, this is a big one that we hear all the time. This is the worst market ever. It's totally unaffordable. No one can do anything. It's just terrible. I could name 2 or 3 much worse markets that you would not want to be into. Does it mean it's a great market? Does it mean that we should all be smiling and saying, hey, I am very fortunate that I get to be looking to buy my first home in this market? No, not at all. But when you have that mindset of it was easier for everyone else, I'm got to wait for the perfect time, this is just the worst market ever, you're going to put yourself into this doom loop that will keep you from ever doing anything, right? So you need to be realistic, but optimistic at the same time, so that when the timing is right and the opportunity presents itself, that you haven't talked yourself completely out of the game, right?
Absolutely. And honestly, the last one was one of the most important, or the most important. This one's the most important. And that is the quality of the information you receive will have a larger impact on your experience to buy a home. It may even keep you from buying a home in some regard, depending on what information you're getting, than anything else. And so your advisors, who you're listening to, not even just your mortgage professional and or your real estate professional. It could be the people that you're listening to on YouTube. It could be podcasts that you're listening to that are, crash mentality, the crash bros, this everything has to change because of X or Y or the black swan or whatever that we've talked about in multiple episodes. The quality of your experience is largely impacted by the people that are advising you through that process. Now, that doesn't mean you need to get out and talk to the agent and the mortgage pro that's like, hey, you should always buy a house. It's, hey, listen, right now might not be the best time to buy a house because we've seen annual appreciation here in Orange County at 8.7% over the last 10 years. That's a fact, actually. That's crazy, right? I mean, it's gone up almost 100% in the last 10 years. But here's the thing. Understanding where rates are going, understanding where inventory is, where demand is, what's likely to happen during this period of time. You need an agent that says that's willing to explain and have these conversations with you, just like anything else. So, just make sure when you're seeking information out there on the internet, you're looking at people, look a little bit deeper than one video, go back a couple of years. What were they saying 2 years ago, 3 years ago at the start of the craziness in the market? Were they talking about a crash then and they're still talking about it now? Because if that's the case, they've been wrong for 3 yeyears. If they were on the flip side talking about house prices going up, housing being important, generational wealth, homeowners being 40 times, having a 40 times greater net worth than those of renters this entire time, then, again, just pay attention to who you're following. I realize this is very self-serving to some extent because we're a podcast that educates you. But the reason we do that is because there is so much bad information out there, Josh.
Yeah. And don't take anyone's word for it. Ask what data they're following. It's one of the things I like about the live show every week, Jeb, is we're able to share the data that we're looking at, rather than cherry picking a piece of doom and gloom data. It is a tough market. It's a different market, unique from almost anyone that we've ever seen. But I can say every month we're successfully putting people into homes. So if the time is right for you, if it is the decision that you are making, get a mortgage person that can explain all of your options and not just say, oh, you don't want to do this, or you have to do this, or this is your only option, that can lay all those things out for you. A realtor that can give you the data on the areas that you're looking in. Because we talk about a lot of this data is broad, and in any market, you can have a local market that is doing significantly better better or significantly worse than the broad market. So it is important that you have professional advisors, including, tax people that are explaining to you what impact this is going to have on your tax situation. Can you really afford this? If you have financial advisors, how is this going to impact your savings and your preparation for building wealth over the long haul? It is important to have good advisors with a broad perspective who can share the data with you to help you make the best and most informed decisions.
And the last lesson, Josh, that I learned that we don't have written down here is that, we give a lot of information out, but we rarely ask for anything. And somewhat shy about asking for referrals, asking for people to reach out if they need help. But that's going to change, guys. If you need a real estate professional locally, you're here in California, you're on the West Coast, Josh can help you. In fact, there's a referral link in the description that will get you in touch with Josh. And if Josh isn't your guy, maybe you're somewhere in the central US or on the East Coast and you need a referral, we can help you in that regard too by clicking that referral link. I sell real estate here in Orange County, can guide you through that process locally. If you're outside of that, the same referral link will get you in touch with those people. But also, if you support the work here, you find value in it, share it with somebody, right? I mean, that's the best, referral that we can receive is somebody else getting the same information, being educated, being guided through the process, and being able to kind of navigate what is probably going to be another crazy market in 2024. So again, if you find any value, share it, like, subscribe, and, we'll see you next time. Till then, adios.
Amigos.